Welcome. Today we're doing a deep dive into an interesting option for life insurance policies you might not need anymore.
That's right. We've got a case study here from Diversified Insurance Brokers.
And it's about something called a life settlement. It's quite different from just, letting a policy lapse or taking the cash surrender value.
Exactly. It involves selling the policy, potentially for, well, quite a bit more money.
So our mission today is really to unpack how that works, look at the money side, and figure out if it's, relevant for folks listening.
Let's jump in.
Okay, so the case study. A client had $1 million universal life policy.
Right, one of those flexible ones with a cash value component.
They'd had it for 12 years, paid in $70,000 in premiums.
Mm-hmm. And the insurance company offered, what was it, 80,000 for the cash surrender.
80,000, yeah. Which, sounds okay on the surface maybe.
But it's often not the whole story. This client looked into a life settlement instead.
And the result was pretty dramatic, actually.
It really was.
They got $300,000.
300,000 compared to the 80,000 surrender value.
That's nearly 4 times more. It just shows there might be hidden value there.
Absolutely.
Yeah.
But then you have to think about taxes, right? How is that 300,000 treated?
Good point. And the source, this TCJA ruling, 2009-13, breaks it down.
It does. So the first $70,000 that matches the premiums paid,
Okay.
that part isn't taxed. It's seen as just getting your own investment back.
Right, return of principal, basically.
Okay.
Okay, so 70,000 tax-free. What about the next chunk?
Well, the next bit is the amount up to the cash value. So
Yeah.
the difference between the 80,000 cash value and the 70,000 premiums.
That's $10,000.
Exactly. That 10,000 is taxed as ordinary income.
Like regular job earnings, that kind of thing. Got it.
Mm-hmm. And then there's the rest.
The big piece,
Fine.
$220,000 more.
Right. That amount, the profit above the cash value, is treated as long-term capital gains.
Ah, and that usually means a lower tax rate than ordinary income, doesn't it?
Often, yes.
Oh.
It can be significantly more favorable. So you can see the financial advantage building up compared to just surrendering.
Definitely. So, okay, the numbers look good potentially, but why would someone actually do this? When does it make sense?
Well, the most common reason is simply that the need for the insurance isn't there anymore.
Like the kids are grown and independent or the house is paid off.
Precisely. Or maybe estate plans have changed. Sometimes, unfortunately, it's about needing funds for, say, rising healthcare costs.
Yeah, that makes sense. New priorities emerge.
Or just different financial goals entirely. People decide they want to use that money differently now.
And presumably, that's where a company like Diversified Insurance Brokers comes in. It doesn't sound like something you just do on your own easily.
No, it's best to have guidance. They help clients understand, all these tax details we just talked about.
Been finding buyers, I guess.
Yes, exploring the market, trying to get the best possible offer, and making sure everything is done correctly, following all the rules. You want someone experienced navigating that.
Okay, so summing up then. If you have a life insurance policy you don't need, don't just assume lapsing it or taking the surrender value is the only choice.
Right. A life settlement could offer substantially more value, like we saw here, 4 times more.
And that extra money could then go towards, well, whatever other goals you have.
It really treats the policy like the asset it might be, even after the original insurance need is gone.
So it leaves us with a question for everyone listening, doesn't it? If you're in that situation with a policy you no longer require.
Is maybe looking into a life settlement worth your time? Could it unlock value for something else?
It's a really powerful example of how knowing all your options can help you make the most of what you already have.
Definitely food for thought. Understanding these less common financial tools can sometimes make a huge difference.